Hello folks, Steve Lentz here with Discover Options. Welcome to this edition of the Market Reports. This will be for Friday, March 24th, getting ready for the open on the 27th. We first have the S&P 500 Condor Butterfly Timing Report for those of you trading butters and condors that want to use technical analysis as a way to better time the entry of those strategies. A lot of people use just seasonals. Hey, put this trade on, between 60 and 70 days, 30 and 40 days left. No. We're going to look at the price action technical analysis to give us an edge. That's what we're going to show you. Also, the S&P 500 Directional Likelihood Report will give you a good statistical understanding of where the market is likely to go based upon the pattern that exists today. Okay, so let's get right to it. Before that, I'd like you to please subscribe, if you could, to our channel, and then we'll get you those notices whenever we publish a new recording. Also, we have a free ebook that you can just click the link and then give us the information. We'll get you this free item as well. That would be great. The current market condition today, as of Friday, was where Friday was a down day where we had a downswing day, a lower high and a lower low. That was occurring while the market was above a 50-day moving average, simple moving average, and then in the stochastic, the 15-3 stochastic was between 1 and 50, yet it was above just barely, you could just see barely above the 3-day simple moving average of that's %D in the stochastic. So remarkably, this is a very rare market condition where you have the stochastic turning up from an oversold place. You have a downswing day when that happened, and it's above the 50-day simple moving average. Long-term trend upward, downswing day while the stochastic is turning up. Very, very interesting, isn't it? So we're going to go to the Condor Butterfly Timing Report. I'm going to show you the results of both reports, and then we're going to go to the methodologies, okay? And for the new folks here. But let's get right to this. So in terms of a butterfly and condor, whether it's a good time right now, and I'm just showing you there the current condition you see at the lower half of the slide. I'll just read the narrative here. Since January of 2000, there have been there have been 4,300 daily closes of the SPX. Okay, that's a lot. Of these 4,300 or so, 64.8% have been favorable bars for selling premium, where the actual 21 bar movement was less than the SIBO skew adjusted implied movement. Okay, that's favorable, right? Where the market moves less than what the options were implying. 64.8% of the bars going back in time to January of 2000 have been favorable that way. That's good for selling, premium through butters and condors. Also during that time, the current condition, what I just showed you, has occurred only 21 times. That's not very many, and you have to question the statistical validity of this. But I'm just going to give you the information. That's what we do here. I'm just going to give you the information and qualify it by saying 21. It'd be a lot more at ease if it was 200, but it's not. It's a rare condition. Of these occurrences, of those 21 occurrences, 52.4% of the bars have been similarly favorable. It's not very many. All right, this implies a premium selling edge of negative 12.4%. Negative 12.4%. So statistically, then it's more likely than normal that Friday's bar will end up having been an unfavorable one for market neutral option premium selling. Okay, so for the Condor Butterfly traders, you want to be very careful. This market condition, although rare, is more likely. It's more likely than normal by quite a bit that things will end up being a bit more rough waters ahead. Doesn't mean that it's guaranteed. We're just telling you what the statistics are. I mean, it's roughly 50-50 shot, coin flip now. right? Instead of before being about a 2/3, 1/3, now it's about 50-50. That's kind of roughly where we're at. So that's the butter and condor. Let's go to the the likelihood report. And you know, for the veterans, you know what this chart's about. If you're new to this, please wait and we'll get into the methodology. But what you'll see here are a lot of blue numbers, meaning that the distribution bands, the volatility bands, are getting struck more often than normal with our market condition that we have now. Particularly on the bullish side, the upper bands appear to be historically have been struck more often after our market condition has occurred. On the downside, the lower bands on the right side, 4 of those you can see here have been, get struck more often than normal. So this is a picture of higher market volatility with a little bit of with a bullish bias. More of the upper bands are getting struck more often than the lower bands. So more of our market volatility, that's why we have a negative edge there, speaking to the previous report. And there's a little bit of a bias on the bullish side if you were to look at these all together. Okay, now, so that's the likelihood. It's likely from this pattern that the market will be more volatile. And if you were to say what more volatile in which direction, well, you would have to say bullish, okay? But altogether, just a greater market volatility in general there. So it doesn't bode well for the premiums, the neutral premium sellers in that sense. When we use different bands measurements using a skew adjusted VIX instead of statistical volatility, and this is kind of showing that the bullish bias is more apparent in this particular case. All right, so leaning to the bullish side with greater market volatility going on as well. Okie dokie. All right, now with that, let's go to the methodology. And so for those of you veterans, those are the reports. We're going to get to the methodology now. This is we explain things the same way. For those that are new, the following slides have been presented many times before, and after you see these a few times, you'll be veterans, and you won't have to stick around for all this. But let's just go through the methodology of these reports because it is important. First, let's look at the butterfly timing report. Why do we look at this? The methodology. Then we'll look at the current edge level. Here, if you're doing butters and condors and you see a market channeling like this, sometimes you'll just go, oh boy, the market's chopping around a bit. Let's put on our butters and condors. Well, if you run it through the algorithms that we use, we would, in this particular case, back in December of 15, find a negative edge based upon this particular pattern. A negative edge existed, meaning that there was a higher than usual likelihood that the market was going to be more volatile than what was implied by the option prices. Okay, and in this case, particularly, the market was far more volatile. All right, now that's one example, but in that case, it turned out to have been predictive. Now we have our current market condition, and here's the question on the table here. Is this current condition a good one for selling option premium through range trading? Okay, we're doing our butterfly condor timing report here. That's the question we're answering. Looking at the market, is this a good time to do a condor or butter? Real simple question, and that's what we're seeking to answer here. How do we answer that question? Well, first we have to define volatility in 2 ways. First, we observe how much the market actually moves from a given close. We call that actual volatility. Then we observe what market move is predicted by the option prices. That's implied volatility. We compare the two in hindsight, okay? Looking back 21 days, 21 bars, a month, and we compare the two later on and then label bars having been either favorable or having been unfavorable for selling premium through range trading, butters and condors. Here's an example. Let's look at actual volatility. Actual volatility. We can take a close, we go forward in time 21 bars, and we ask ourselves, how far did the market move from that close? What was the farthest it moved either up or down. We go forward 21 bars, and clearly it went down the farthest. It went down far more than it went up. Okay, it went down, it turned out, about 50 points from the close to the lowest low. That turns out to have been 2.4% of the market at the time, and we can chart that in a little indicator line there in my Metastock program. Okay, now we know it was 2.4%. So now, what market move, though, was being implied by the option prices at that time? And when we go back and look at the skew adjusted VIX, okay, we run it through a calculation to find out the implied move was 4.4%. So the implied move was 4.4. It actually moved only 2.4. That turned out to have been a favorable bar for selling premium. Okay, the options implied far more than what actually took place. So we would paint that bar blue. Okay, we would paint that bar blue, and we paint all the bars blue where the implied turned out to have been more than what actually came to pass. If the market moved more than what was being implied, we paint those bars red. We have favorable in blue, unfavorable in red. Okay, so now what do? Okay, we have 4,300 bars going back to Jan of 2000, all painted blue and red. Okay, what do we do at this point? Well, first we're going to look at what percentage of all those bars were favorable. Then we're going to look at the bars that match our current condition and see how they compare. What percentage of those were historically favorable for selling premium? And we're going to define our edge if by the difference between those two. Okay, so let's just keep going here. Here's the deal. You go back and look at all the bars in the SPX. 64.8% of them were favorable. 35.2 were unfavorable. So that means when putting on a Bud or a Condor, you can flip a coin, and it's a little bit less than having a 2/3 chance of catching a bar that's favorable. 1/3 chance for catching a bar, a little bit more than 1/3 chance of catching a bar that's unfavorable, where it's going to move more than what was implied. Now, hopefully you have a nice adjustment approach to your strategy so that you can adjust your position as the market moves. If you don't, then you should come to us at Discover Options, and we'll show you how to adjust your Budders and Condors accordingly, okay? So that's that. That is the baseline percent of favorable bars. Then what do? Well, then we look at our current condition. And of the bars that match our current condition, of which there were not very many, what percentage of those were favorable for selling premium? And what we learn is only 52.4% going way back ended up being favorable. Not very many. And so when you then compare it to the baseline, we discover a negative edge, that there's a higher than usual likelihood that the market will be more volatile than what is implied by the option prices. Negative 12.4%. All right, so that's the methodology we use. Now, before we get to the likelihood report, I want to make sure you remember Discover Options has a fantastic curriculum to educate you in your options trading, whether you want to become a money manager yourself or just simply manage your own money in a more professional way with greater expertise. We have one-on-one mentoring sessions to make sure you get the concepts. We'll answer all your questions and really examine the strategies that you're using and make sure that you get this. Okay, our mentors, started on the floor of the exchange. They manage money themselves, and they're doing well, and we want you to do well also. So give us a call. We'd love to walk you through that. Now, here's the likelihood report. Let's dive into the methodology of this and understand, since Jan of 2000, how often, here's the question on the table, since Jan of 2000, how often has this same market condition occurred? And what did the market do in terms of direction and volatility? So here's we have our market condition here. It's kind of unique. If you went back and looked at every time it made this same condition, what if we discovered that every time it did this, the market went up dramatically? Well, you'd probably be more confident going bullish. What if you discovered that every time it made this particular condition, the market ended up being down substantially within 5-10 days? I mean, you would be interested in that, right? So that's what we're gonna do. That's what the question we're gonna answer is, okay, how often has this condition occurred and what did the market do? Well, here's how we do this. To answer that question and create a framework for determining that, we need to create a framework of distribution of price. We're going to look at the historical distribution of price. Then we're going to understand the price distribution after a specific market condition develops, like the one we just had. Okay, we'll compare the two then to see what the edge is, and we'll measure that. So how do we do distribution of price? What we do is we look at one standard deviation volatility bands placed a certain distance from each bar's closing price. Okay, and those are we have three sets of upward bands, upper bands, 5, 10, and 15 days out, and then three sets of lower bands, 5, 10, and 15 days out. We're using, these bands are set one standard deviation from the close, and we use a 20-day historical volatility or statistical volatility to determine that width. These are normally distributed, of course. Here's just a quick example. Okay, we have the upper 10-day band, the lower 10-day band, and what we're just looking at is how often, or in this particular case, excuse me, from this close, did price hit the upper band, the lower band, or wobble around and do nothing? Okay. In this case, the market definitely went up and hit the upper band. So for that particular close, we record that it hit the upper band. Now for this close, we have the upper bar, or the upper band, the lower band, and the question here is, did price go up and hit this one? Did it go down and hit this one, or wobble around? Let's take a look. Okay, if you look carefully, here's the band. It tried to go down and hit it, failed to. So in this case, we record it hit neither band. So when we look at distribution, we're doing it from every close. And so from every close, we record whether price struck the upper and the lower 5, 10, and 15-day bands, and we keep those statistics. And here are the statistics through March 24th of this year, going back from Jan of 2000 up through March 24th. Okay, price hit the upper 5-day band 29.6% of the time, the upper 10-day band 23.3%, upper 15 23.3%. It hit the lower band 29.4%, 28.9%, and 31.8% out of 4,302 closes. So that's the distribution of price. It hit the upper bands between 23 and 30% of the time. It hit the lower bands between 29 and 32% of the time. Interesting, huh? So that's the historical distribution of price. Now, let's look at the distribution after our condition developed. Okay. Just a second. Let me close this. Get rid of my volume on there. I'm sorry. So, the distribution we're going to look at distribution as of the close on Friday. We're also going to look at the historical distribution when price went above the previous day's high, and also the distribution after it went below the previous day's low. Why? Because then when Monday comes and price blasts off above the high from Friday, you'll know what the distribution was historically in that case. Or if it goes down below the low of Friday, you'll know what the distribution was in that case. That gives you a better trading plan for Friday in terms of just some statistics moving forward. All right, so we had 21 occurrences of this market condition. Of those 21 occurrences, price hit the upper 5-day band 42.9% of the time, which is a bit more than 29.6%. 13.3% more often, in fact. Price hit the upper 10-day band 33.3% of the time. That's 10% more than the historical base. It hit the upper 15-day band 33.3% of the time, which is higher than the 23 by 10%. Okay, so it hit the upper the three bands, it hit them more often than what was historically a baseline there. So there's a clear indication that statistically we're leaning a little bullish. Now it also, look at this, it hit the lower 5-day band, just a little bit less, 5% less than the baseline. It hit the lower 10-day band, 33.3, which is more, and also the lower 15-day band, 33.3, which is slightly more. Okay, so all in all, we're seeing a little bit of a bullish bias there from the close. Now let's go to what happened in those 9 instances when price exceeded the high. When it exceeded the high, well, it then went up and hit that upper 5 and 10-day band more often than normal. It hit the upper 15-day band less often, and it hit all 3 of the lower bands less often than normal. Okay, so a little bit of bullish bias there. And then when price went down below the low of the previous day, let's say if it blasts down below the low of Friday, again, the upper bands were struck more often, and 2 of the 3 lower bands were struck more often. Altogether, a picture of higher market volatility. Now, what I like to do is also readjust the bands to reflect the skew-adjusted VIX. And so the bands are going to be a little wider out because the VIX is higher than statistical typically. So it's the baseline is that shows that it struck those bands on base less often than using statistical. Then when you run the numbers using the bands there, you'll see that the bullish side bands got struck more often across the board, and the lower bands got struck less often in most cases here. Again, a bullish bias, with just greater market volatility in general, but definitely with that bullish bias. Does it mean it's going to go up? No, it means that historically, when this rare condition has happened, that the results were that it went up greater than the baseline distribution. That's all it's saying. Okay, so there's definitely a bias towards the bullish side. Okay, that's the methodology, folks. I hope this has been helpful for your weekend trading. Here we go. Click, go back. Very good. Folks, I'm Steve Lentz with Discover Options. Thank you for joining us. Bye-bye.